Hotly anticipated Nvidia earnings are on deck. There's a lot riding on these results. But what happens if the bears are right? Dom Chu is here to break it down and with a special guest.
That's why there's a portfolio insurance in the options market these days, Tyler. So Nvidia does report, as we know, after the closing bell tomorrow. It's a stock that's had a tremendous run, 180% in just the last year or so. But what if those earnings and the outlook are less than what investors in Wall Street are hoping for? Tony Zhang is the chief strategist over at OptionsPlay. He's with us live today. And Tony, we talked about portfolio insurance and, puts and calls are the basics of options. We're talking put options or downside protection. Take us through your trade on Nvidia tomorrow.
Yeah, that's exactly right. This is a trade that allows you to participate in terms of upside, but provide a little bit of downside protection going into earnings tomorrow. That's by going out to the September 20th expiration, buying the 124 puts, but at the same time selling the 110 puts against that. Earlier today, you can pay about $4.66 debit for that put vertical spread. What that allows you to do is actually reduce the amount of risk that it takes to buy that downside protection by selling that 110 put down, which costs you only about 3.5% of the stock's value. And what that means is that if, let's say, Nvidia does report far better than expected earnings and the stock jumps another 10, 15% like it has done in the past previous quarters, you're only giving up 3.5% of that upside. So if the stock, let's say, rises 10%, on earnings tomorrow, you're giving up 3.5% of that, so you're netting about 6.5%. But this is a trade that's going to give you downside protection of about 14% to the downside. So if if we see AI, if we see demand slow down a little bit or outlook for Nvidia come in a little softer than what investors are expecting, we might see a bit of a decline in terms of Nvidia to the downside on earnings. This will buy you some protection to the downside.
So, Tony, let me ask you a couple of questions here. I suspect that a lot of people who do this would be sophisticated traders who may well be executing their trades on their own at their desks at home. But if I were to call my broker and say, I want to do what Tony just told me to do, what do I say to him or her? Is there a name for this trade? Or what do I tell them quickly? I say, I want to buy these and sell these. What is it? What do I tell them?
Yeah, it's a long put vertical or a bull or a bear put spread that you could usually go by in terms of the name structure. But like I said, what you're doing is you're buying the September 124 puts and you're selling the September 110 puts at the same time. So it's the same expiration. You're buying the higher strike price, selling that lower strike price. Net, you're going to pay about $4.60 earlier today for that. You can tell your broker that and they'll be able to execute that trade on your behalf.
All right, Tony, thank you very much for that. Now, Tyler, so in essence, what we're talking about is you want to buy the downside protection that'll protect you for anything below $124 in price. But what you're going to do to make that insurance a little bit cheaper is to sell the 110 below this level to make it cheaper to buy that portfolio insurance. But if you own the stock, you still get the upside if it goes higher.
The word name for it is?
Bear put spread.
Bear put spread.
There you go.
There you go. Dom Chu, thanks.